Retail sales in June came in cooler than expected, advancing by just 0.2% month over month. The expected increase was 0.5%. Now, this is the third consecutive month of positive retail sales, but the report shows decelerations in many discretionary categories like department stores, gas stations even, garden equipment, and hobby stores. Could this report throw a bucket of water on the soft landing crowd? We want to bring back in Liz Young, SoFi head of investment strategy. So we've talked obviously about the consumer and potential kind of cracks in the armor, if you will. So what does this do first with that question with regard to kind of the thesis for the soft landing crowd?
I'm still not clear on what soft landing means. I think it means different things to different people. I think to some of the crowd, it means no recession at all.
Right.
I think to some of the crowd, it means a mild recession.
Right.
So
what does a mild recession even mean, for example?
Right, and then you have to get into the weeds of what does an average recession look like. So I'm going to say there's classic recession, which is, as we talked about, something that resets the cycle. You've got unemployment that rises, consumer spending comes down, you see a blowout in credit spreads, the market comes down, right? So classic recession. I think soft landing is probably something much more mild than a classic recession. In that scenario, I would actually envision that retail sales softens and that the consumer stops spending as frivolously, perhaps, as they were right out of the pandemic. Now, first of all, it's important to note that retail sales is much like consumer sentiment readings. They can be very fickle. They change very quickly. But here's the thing that's also important to remember about retail sales. If you start to see a trend of slowing and then contracting in retail sales, that usually indicates that the consumer has, at least in the medium term, pulled back, hit the brakes, hit the pause button, right? So what could happen is we had a bunch of revenge spending after the pandemic, and that revenge spending lasted a long time. And some people are still engaging.
I was going to say,
right?
It's still happening for some.
It's probably not over.
Experiences, you know.
Exactly, right. So it started with stuff. We all bought a bunch of stuff, and then it went into experiences. And I think some of that is still going. I mean, ask Taylor Swift how it's going. I think it's going really, really well, right?
Yes.
So there's still a lot of that sort of revenge FOMO spending that's happening, and travel is still pretty hot. People are now traveling internationally, and that's a big thing. Over time, what you see, and what we've already heard some indications of, is when you watch things like retail sales, that's the smaller stuff, right? That's people going out and buying apparel and smaller spending. What you also want to watch in concert with it is durable goods. And durable goods spending has slowed down a bit. Durable goods, for anybody who's not aware, is things like big ticket items, right? Washing machines, right? Or things that you have to put into your house when you're remodeling it. And durable goods spending is usually one of the first things that people slow down on. Like, let's hold off on that washing machine purchase until we're sure that inflation is actually going to come down, right? In the last couple of months, I think consumers are feeling pretty great. I think market is up, inflation is down, they still have a job, and it's like, you know what? Let's do it again, right? So you might see a little resurgence in spending just because of how the sentiment surveys have come in. Sentiment surveys tend to be a little bit more real-time. Consumer spending and retail is a little bit more backward-looking, so I wouldn't be surprised to see retail get a little bit of a bump the next reading that we get.
I mean, it's really interesting you say that, because two of the strongest areas, which really surprised me, furniture and home furnishings, and electronics and appliances. Which who would have thought that we would be talking about that at this point? When you're looking at the market, is consumer discretionary an area that's interesting to you, or not, given kind of what you're saying?
And you have to be really careful about the consumer discretionary sector. There are certain companies that fall into that drive a lot of the behavior. And if you take those companies out, actually the sector looks very different. But consumer discretionary has gotten swept up into not necessarily the AI boom, but this growth rally that's happened in 2023. I think it looks extended from a valuation perspective. Generally speaking, so you can look at a couple different things. You can look at the ratio of consumer discretionary to consumer staples, and that would tell you whether or not the market was feeling comfortable cyclically. Does the market expect a cyclical expansion? So if discretionary is outperforming staples, then the market is feeling pretty good. And right now, that's what's happening, right? at some point, those big gaps, again, they do tend to narrow. And I think in the case of consumer discretionary, just because of how high valuations are, the more likely scenario is that discretionary lets a little bit of air out of the balloon and staples maybe middles along. If we get a spike in volatility, you'll see staples come back into the forefront. And that's something, too, that I think as you watch the market and think about sectors, the VIX is incredibly subdued. I'm looking at a chart of it right now. The VIX is incredibly subdued, asleep, perhaps. We could even say the VIX is like, I'm done. I'm going to go chill out for summer. I'm not paying attention. And this is a time when, although it feels counterintuitive, this is a time when you actually want to have some defensives in the portfolio because it's probably not going to stay subdued forever. Now, spikes also don't last very long. So it's not as if I'm saying, it's going to go up to 25 and stay there for 2 months. No, so if there's a spike, that's the definition of a spike, right? It spikes and then and then it just sort of dies off. But you do want to have some exposure there. So not getting overly exposed to things like consumer discretionary and expecting that the recent past is going to extrapolate out into the future forever. Stocks don't only go up, right? And volatility will probably go up at some point in the next 6 months, and you want to be prepared for that.
Okay. I like
Good to keep in mind. And on the consumer discretionary front, they are later in the earnings season. At least the retailers are more towards the end of August. So that's something to keep an eye out for. Liz, thank you so much for coming in and spending some time with us.
Thank you for having me.
Good to see you. Liz Young is SoFi Head of Investment Strategy.